So if you look at the UK investment trust market, you can actually see over the last 5, maybe even 10 years, the real asset side of things has been incredibly popular. However, what's really been in the market to date has been very much UK focused, or maybe even European focused. So UK real estate, UK infrastructure, or even some kind of European version of that. We have a significant real assets platform, and actually we're global. So what we thought we could do is actually bring a much more global outlook to the real asset market, to obviously what has been a very popular and very successful vehicle within the investment trust space. We think of real assets on a spectrum. So at one end you've got kind of core real assets. These are the high quality end of the spectrum, so high quality locations, hopefully facing off against high quality counterparties. And at the other end of the spectrum you've got more opportunistic real assets. These should be slightly higher risk and much more capital appreciation focused. So to think about that in a real estate context, you've got New York office building, maybe with an investment grade counterparty or an investment grade tenant. That's really an income-focused return profile. However, an opportunistic real asset would be buying land, looking to build on it and sell it for a profit. There's no right, there's no wrong way, but we're very much core focused, and all of the assets within this fund have a core mindset in that income, and predictable income is really the main driver of return. You have a relatively predictable and differentiated return profile. So what we're looking to achieve is a 7 to 9% net total return, 4 to 6%, so around 2/3 of that from income. That's once we're fully invested and we're still very much in our ramp-up phase. A lot of that return on the income side comes from high quality counterparties, and actually therefore it should be predictable in nature. And so in providing a cornerstone allocation and a cornerstone return profile, that should be something which is predictable and can sit there and really be a nice diversifier within people's portfolios. So I think if you think about what can happen with equities, obviously you can have good years and bad years. You can look at 2019 where you had an excellent year for equities, 25–30% equity markets. You're not necessarily going to expect that out of real assets. It's going to be much more slow and steady. 7 to 9% would be what we're looking to achieve over the long term, but hopefully it should be more predictable in nature. So the negative part of the return profile, although it definitely can happen, given the fact that you have the reliance on income, should be something which you're much more insulated from. So yes, on the equity side you can have higher beta and therefore higher returns, but our return profile should hopefully be more predictable in nature. Well, obviously we've been saying late cycle for a while now. I'm not going to put myself out and say where we are. I'd say we're closer to the end than the beginning. But really, actually, real assets have been shown over different market cycles to have a pretty robust return profile. And so actually, particularly on the core end of the spectrum, when you're thinking about volatility that you can often get in the late part of the market cycle, these real assets should be actually an ideal part of the portfolio that can still produce a pretty predictable return. And therefore, if you have some wider volatility, maybe in bonds or equities, this can be that more core part of a diversifying portfolio. We do very much view real assets across all the categories, so real estate, infrastructure and transport, as very much a cycle agnostic asset class. However, if there are periods of volatility, that's actually when we'd hope them to outperform wider markets as well.